With the volatility across U.S. markets, should investors be looking overseas? I'm joined now by Brian Jacobsen, Chief Portfolio Strategist at Wells Fargo Funds Management. And Brian, it's great to have you here. Welcome.
Thank you.
So you say with 3,000 stocks in the U.S. and 18,000 across the globe, why limit yourself to just 1/6 of the opportunities out there?
That's correct. When it comes to constructing a portfolio, I firmly believe that the wider the opportunity set that you can look at, the better the portfolio you can construct.
And the big question, though, people have is, okay, where do you invest overseas? Are we talking Europe or emerging markets or both?
I think that in this type of environment, from a valuation perspective, it really makes a lot of sense to look at emerging markets broadly, and then specifically in the developed world in Europe. However, with valuations, you don't know about the timing, but I believe that there are a number of catalysts on the horizon that can unlock some of those valuation opportunities.
Which are?
I believe that really for the month of October, one thing that could unlock some of those valuation opportunities would be a Federal Reserve that continues to be on hold. The more they push out that first liftoff date, or the lower the trajectory of rate hikes when they do start, I think that would actually be very beneficial for emerging markets in particular.
And on that note, with Europe, the stimulus there from the European Central Bank, the quantitative easing program, that certainly is good for stocks.
That is, and that's another thing that could happen at the end of October, making October, I think, an incredible opportunity month for people to reallocate their portfolios. If, as Mario Draghi has intimated, they are willing and able to either expand or extend their asset purchase program, that should be further supportive of European equities.
Of course, everyone remembers this year the volatility we've been seeing out of China, which is causing a lot of market swings in the U.S. markets. Tell us what your take right now is on China. We've been seeing some better economic data in recent days out of China. Do you think better days are ahead for their economy?
I do, and one of the key things, I think, is what happens between October 26th and October 29th, when the Chinese Communist Party, when they complete their fifth plenum. They're going to be laying out a 5-year plan. I'm looking to see whether or not they recommit themselves to market reforms. If they decide to backtrack on market reforms, then I would probably abandon ship. But I believe they're fully committed to this path of actually increasing market liberalization, which should be good for the long-term growth of China and the global economy.
So when you say abandon ship, for people who are already invested in China stocks, but for people who maybe are sitting on the sidelines, is it too risky to get in now?
I don't believe it is too risky, although I wouldn't necessarily be in a huge hurry. Keep in mind, though, when it comes to market volatility, emerging markets, the volatility can be somewhat front-loaded. So when you see big gains in their markets, it tends to be concentrated in a few days. So I would actually be looking at getting there now as opposed to waiting too long.
And investors are also pretty confident that the Chinese government will continue to intervene with more stimulus.
That's correct. So it's this weird mix of market liberalization, but also with government intervention. But the government intervention is to support this path towards more sustainable growth.
So if investors are going to head overseas, what percentage of their portfolio should be in U.S. stocks versus, say, China or Europe or emerging markets?
Well, broadly speaking, I think that investors should be looking at maybe consider 66% of their equity allocation to be outside of the United States. And I come at that number from a number of different perspectives. Number one is the valuation opportunity. U.S. stocks, I believe, are fairly valued, but it's not a great value. Where are the great values? It's more outside of the United States. The second approach that I look at is really from a risk management perspective. A globally diversified portfolio has lower volatility than a U.S.-only portfolio. And as a result, I think it really makes a lot of sense for people who don't like the volatility of the U.S. markets is to diversify outside of the U.S.
All right, Brian, we'll leave it there. Brian Jacobsen, thanks very much for the advice.
Thank you.
I'm Scott Gamm, and you're watching The Street.